so I wanted to make sure that we had a chance here to just look at our market for 2010 and talk a little bit about what's going on. One of the things that you may remember from last year, any of you that saw it, we had a look at what our market has done for the last 5 years and perhaps the landing that we might anticipate. You all remember that? Well, there's a little more to that than meets the eye. One of the things I wanted to just present a little bit is the idea that when we look at that smooth landing and all the things that go into it, we also need to look at what really goes on in the last 3 years and probably the next 3 or 4. You remember this part? Surprise. This has been our market for the last couple of years. This is the way it is now. Anybody feel like this for the last several years? Well, this is what we hope it turns out to be. One of the things that we have to do is change that massive roller coaster and all the thrill ride into something that we could probably live with just a little bit. Because something that we have to look at is that the recovery that we're all looking for is probably not an up escalator at the mall. It's more like this roller coaster, but we hope it isn't a thrill ride. So the message of the coaster is that, during 2006 and certainly the early 2007-8 years, we had both falling prices and falling volume. And I started charting this stuff several years ago. I wish I'd been looking at it back in 2003, 4, and 5, because it would have been obvious what's going on, and I think you'll see that and share it with me in just a few minutes. A lot of national hype, of course, about what happened, and the rest of the country was behind us by a couple of years. They were still talking about growth and all kinds of things in 2005 and 6, and we'd already seen the turn at that point. 2008-9, we saw rising sales volume and increasing volume every year as prices unfortunately continued to decline during that part. So we had a classic situation of kind of an accelerating downturn. The good news is that 2009 to 2010, we're looking at a continuing increase in sales. And one of the things that we've done, and this is something I'm going to take issue and hope that all of you support, the idea that we need to talk about our market a little differently than some of the headlines. We've had single-digit type declines or settling in the market, but we have quit falling quite a long time ago, in fact, about 20 months ago. So I think this is one of the things we need to pay attention to. So what's going on? Well, we're going to talk a little bit about the inventory. We're going to talk about home sales. We're going to talk about the home prices a little bit. Something about distressed properties. Certainly the market mix, so you can get an idea of where things are happening. And those people that we actually deal with most of the time, the buyers and sellers. So let's take a look at this. One of the things that we can talk about is inventory. And there's a lot of talk about how there's massive amounts of inventory laying around, but let's talk about what's really happening. The actual inventory from 2008 was a little over 3,000 units of unsold, and now we're looking at about 2,100, and actually as of this morning, it was about 1,960 or so. So we're looking at that many homes for sale, single-family homes in the greater Reno-Sparks market. It's not 4,000 or 5,000, so I think we need to put that in perspective. One of the other things that we hear about all the time, of course, is we talk about prices and we talk about actual sales units and volume. And we're in the unit business in some ways. We're also in the price business. But one of the things that we're responsible for is helping people get their homes, sold, and certainly getting new people to buy. So let's talk about what's happened since January of 2000. We saw increasing sales volume on a regular basis. We saw the big decline, and now during the last several years we've seen a steady uptick. One of the things that's important to note is our lows are getting higher and our highs are getting higher. And we're doing this in the last 6 months or so without federal intervention, help, okay? Now, one of the things that we also need to look at, of course, is pricing. And one of the things that we can see is that from 2000, we saw that ramp up and then that massive decline. But look at the last couple of years. We're looking at mostly a lateral trend or something moving to the side. Now, one of the things that we can see if we look at this is the current level of pricing is somewhere in that 2001, 2002 level. It varies month to month, but that's about where we are now. And if we look at a trend from 1990, and actually I went back and actually priced out my house that I bought in 1976 in Huffaker Hills. I bought a house for $39,500. I got transferred to Denver in 1969 and sold it for $73,000. We had a boom then too. If you remember, we opened 3 casinos in 1978 in the same summer, same month. We had a lot going on. We had no water then, by the way. Another, little aside there. But during that time, you look at the pricing trend, and if you look at, I took that same house and looked at what it was on that same court just recently, and if you look at that long-term piece, it went up and it went down and went up and it went down, but it's a 4% growth basically from 1976. So what have we got? We've got a trend from 1990 where we have measurable results, and this is pretty much where we would be if we had had no boom. Now, it's not significant in the sense that nobody said we had to be there, but that's what a 4% growth does, and as you can see, we're kind of overcorrected at this particular point. Now, one of the things we don't talk about publicly that much is something we call market absorption. And one of the things about market absorption is the attempt for the market to absorb itself. In other words, as new inventory comes on, we sell, and we look at the number of months of inventory that it would take to close out the market, kind of like closing business sale. So if you had an inventory at Macy's and we're going to close the doors, you would sell off everything. How many months would it take to do that? The National Association of Realtors thinks that, and so if you look at this history from 2000, you can see that we actually spent very little time in the balanced area. During our run-up, we went up 120% in 3 years to the peak in 2006 January for pricing, and also for sales during that time we actually had low inventory, and as many of you know, it took if you were going out showing somebody a home in an affordable price range, you might only have 3 to look at, and you'd better write an offer on the island in the kitchen before going back to the office, because it'd be too late if you waited to go back. Well, those days are changed a bit. We've got inventory now. We have it, fortunately, in the most popular price ranges. The balanced inventory number that we have for December slipped a little in January, and you'll see those numbers in your reports that we publish on Reno Sparks Association Realtor website, rsar.net, and you'll see those in a couple of weeks. The bonus for all this is that we're absorbing this inventory without, or in spite of our unemployment numbers and without government help at this point, and that's the good news, I think. Now, the message of the market numbers, we're actually stabilizing, and I think that's an important piece. Does it mean it'll continue? Not necessarily, but it does mean that we have stabilized prices and we have increased demand, and I think we need to pay attention to that. There's certainly an attempt at bottoming. We tried to bottom this market, if you want to call it that, back in 2007, and there was a 10-month period there where the market actually went up in value, up in price for a few months. But then Bear Stearns happened, and we went down to the trough. Now we're certainly away from that, and we've been moving in single-digit numbers to the right. So is this an early recovery? I'm not so sure, but we have certainly some good signs, and that's what we need to do. So let's look at something that we haven't presented before in a public forum, and that's market absorption by price range. One of the things that we're going to do is look at the ranges. Now, from the back, you may not be able to see some of these numbers, the back of the front even. So we're looking at the price ranges of 1 to 100,000, 150, 100 to 150, 150 to 200, 250, and so on. Then we go 300 to 4, 4 to 5, 5 to 750, and then to $1 million and beyond. These are the months of inventory. So what you can see here is that the average is about 7 months. So most of the inventory we have in the popular price ranges are pretty much either at a slight decline from that or certainly right on money. Now, something that I thought was kind of fun, and we messed around with this a little bit to see what we could do, December of 2010 versus December of 2005. And this is kind of an interesting thing. What we're showing is actives and solds in the price ranges that I just mentioned. So if you look at this past December, just a month ago, we're looking at most of our sales being in the 100, under 100, 100 to 150, 150 to 2, and 200 to 250, and it tapers down till we level out. Now that's the most popular price ranges, and you can see that we've got some pretty good inventory, okay? Let's look at December 2005. Anybody venture a guess who wasn't at the band forecast, okay? Anybody venture a guess as to how many active listings there were in the 100 to 150 range in December of 2005? How many?
None. 0.
How about 4? There were 2 sales that month. It's amazing. Where were the sales? Well, if you remember, starter homes were in that 250 to 350 range, and we were looking at crazy loans to get them. One of the things that's a real message from this, and we'll make sure that we emphasize it, is that we're looking at affordability, and that's probably something we need to pay a lot of attention to. Now, active listings are an important part of our life, and these numbers are from December. Those numbers have changed just a little bit, but they're still not that far off. We're under 2,000 active listings right now in single-family homes in the greater Reno-Sparks area. So looking first at no special conditions, that's our favorite category, none, the people with equity and those that think they have equity. Some of these may be just a tad overpriced, like 20% or more in some cases, but these are the individuals that are trying to not be a short sale, and some actually do have equity and of course paid cash for homes or have low mortgages so they can walk away with some money in their pocket to move somewhere else. It's really important to think about that particular factor. As you look at this, over 2,200 or so active listings in that category back in 2008, and presently in that category we're pushing 900 or so. Now, short sales were not really, we didn't really pay much attention to them prior to 2007 and 8. They weren't a category. We didn't track those numbers. So what we're looking for right now is something to replace some of that inventory, and certainly short sales have done that. So short sales certainly are a big factor in our inventory. And last but not least are the REO bank-owned properties, including Fannies and Freddies and some of the things that are not technically bank-owned. This particular chart shows that we had a bump in 2008 and early 9 where the banks did release quite a few homes and kind of dumped some things on the market, and that certainly caused a pricing challenge for a little while. But I think as we've seen recently, most of that has been metered, and here we go. Now, one of the things that is a hard one, and I know you can't see the detail on this, but you can see probably the big spikes. This is the percentage of our new listings each month that are distressed. And by distressed, we're talking about the ones that are short sales and the ones that are bank-owned REOs. We've had several peaks, and back in January of 2008, we were at about 38% distressed. We moved to a high of 70 in November of 08 or so. Then we moved to a high of 74% in October or so of 09, November. Then we dipped again, and we've actually had last year less of our new listings coming on, were distressed each month, and we finally hit December at 75%. So looking at these numbers, we're still, of course, focusing on a distressed market, but one that's moving, and that's the important thing. Now, this is something that got picked up when we talked about this a couple of weeks ago, and it's something that we have to think about. 2/3 of our sellers no longer turn into buyers. Think about it. We used to have a situation where a typical seller sold their house, moved across town, bought something bigger or smaller, moved to Oregon, did something with their life, and bought a home in another community perhaps, but those people moved around the country and bought homes. Our local sellers, and Las Vegas especially, 2/3 of our sellers don't turn into buyers. 1/3 of them are banks. 1/3 of the sellers are basically banks and investors who don't buy another house because of it. They're trying to get rid of one. 1/3 are short sales, and they're certainly in a distressed position. Of Credit-wise, they're typically not able to buy another home for several years. And as we were talking before the meeting, they only start to recover in that credit if they work at it and get a job and do the things you need to rebuild a life after a short sale. So neither one of those groups buys a replacement house when they sell. So our society, unfortunately, has become less mobile than it was before, and that's something we probably need to adjust to as we face the future. Discretionary moves have declined, and that's just a factor we have to live with, I think. However, that's not a doom and gloom thing, and I'll show you that in a minute. Now, the mix of homes in 2008, we saw the preponderance of home sales in the no special conditions equity position with the rising influence of REO properties and a tiny 8% or so of short sales. 2009, we saw half the market being REO properties and about 20% being short sales. And most recently, we finished up 2010 almost equally balanced, if you want to call that balanced, with short sales and bank owns competing with no special conditions for about an even percentage of the sales. Putting those together, one of the things we have is this chart, and it combines sales and pricing. So the top line, the blue line, is the rapid run-up in pricing, 120%, 121% in 3 years, a decline that happened almost as fast and continued on into the present time in terms of decline, and I use the word decline and not falling anymore. So my message to everyone and a request is we need to get rid of those headlines that talk about plummeting prices and falling markets, because that hasn't been true for almost 20 months. Sales are up. And I think it's important to note that sales are up since the tax credit expired, and we just finished some really important months. Now, what kind of surprises await us? Well, we're looking at some things with the Gen Y and millennial, the whole baby boomers kids and their kids as they come into the market over time. And one of the messages for all this is that we need to pop these balloons. So we have new buyers, they have new needs and expectations, and we need to get into the mix and try to figure out what it is they want. One of the things they probably don't necessarily want is they're not necessarily buying their parents' homes. So as we move forward, new construction and other things will certainly take note of this and build homes in walking distance to jobs, all kinds of other things with group activities, recreation areas, and so on, and a little less lawn mowing and lots of the other things that my generation probably got in love with, although I personally am still doing it, but reluctantly. Now, one of the other things that we don't think about too much is the fact that population alone is certainly going to be a factor in this. And as we pop that balloon, we end up with natural population growth. And we end up with the ability to grow ourselves into some recovery just by virtue of increasing number of people wanting homes. And that's a big deal. Probably one of the other things that happens is that we look at our neighbors. And probably the biggest thing we have going for us is California. It's also the biggest thing we have going for us. So as they go, we go to some extent. One of the things we have, and we've always been a little insulated from some of their ups and downs, but if you look at more current times, we're looking at migration being an important piece. And one of the things that one of my friends just touted me to was the fact that in counseling retirees from places like AT&T and other large companies that have real retirement programs, 50% of the potential retirees that are facing that over the next year or so, many of them, 50%, are saying that they're planning to leave the state. That's California, that is. Now, factually, only about 25% actually do. But there's potentially a couple of million people involved, and 25% is 500,000. And if we get even a few of those, we end up with some people that probably can afford to move here. So let's get rid of that and make sure that we get new residents and retirees and some of the people that may come to our market. Now, looking at some parting thoughts. One of the things that we have to think about a little bit is that We just finished December. December was the largest December sales month in history. And all the doom and gloom we hear about things, that's a fact. And January, although the numbers aren't out officially yet, is the second largest January in history. So these things are going on right under our nose, and we're actually participating in making it happen because we're selling those homes. So investors are buying now because rental properties actually pencil. One of the things that hasn't been true in the past is that a typical single-family home, if you bought it, you had to face negative cash flow. Well, that isn't true anymore. If you're buying in that 150, 100 range, almost every one of those homes will pencil out, and investors are buying those because they're good buys. If you think about what happened during 2002, 3, 4, and 5, people were buying homes out of desperation to catch it before it got even higher, but they were looking to make money on the sale, and then they forgot that they had to sell it to make the money. If you think about it, you go homeless to make a profit. And it didn't really work out that way. Last but not least, real estate, if purchased correctly and for the right reasons, is still a good long-term investment. I think we all need to look into that very carefully and make sure that we follow that in the market. Thanks very much.